Okay, now we're back again. Again, we got, I think, 1 minute. We'll get started here. I do apologize for this inconvenience. It kind of slowed your day down a bit. Hopefully you gave ample time for the presentation today. And more so, I hope that everything that we present to you is worth it. And you get a lot out of it, and I think you will. We've got a lot of good information here. Typically, the market, past and present, has a lot of information on it or in it, and it gives you a good perspective of what we just went through the previous year, where we are today, and what we're looking for moving forward as the market continues to roll on here. So we're gonna go ahead and start, and I am going to take the reins here for a second. Yep. As we move forward, where we have been. This is we got some real nice pictures there for you. We're going to start with COVID, and I'm going to hit this from a pretty high level. We're not going to get too far in the weeds on this. It's more of an overview of what happened last year. This first slide is really the EU, European Union, versus the US relative to services business activity. How did both areas work and travail through this process that we had last year, the pandemic? And you can see the US, which is the gold line, and the EU, which is the blue line, kind of gives a pretty big story there. In the beginning, December, January, February, you could see the US is still in an expansion. We had a heck of a year in 2019, and it really helped propel us into 2020. And I think it's one of the things from an economic standpoint that helped us get through this. You look at the EU, you can see in the first few months, it was running a little bit flat. And when we actually hit the shutdowns, not just in the US, but in the EU and worldwide, you can see that the EU, because of multiple reasons, one being the fact that it was running kind of a slow economy, and two, it shut down really more severely than the US did. And you can see how it really took a toll on business activity. Both the US and the EU were kind of out of the woods by June as far as getting things back on track. But what happened is the US kind of stayed pretty steady, and when that second wave started to hit, the EU started shutting down, albeit nowhere near as bad as it was before. So all in all, the U.S. did really a fantastic job of getting ourselves back on track from this pandemic and the subsequent shutdown that occurred across the world. Now, if you look at the U.S. COVID-19 cases versus death, it started out pretty scary for everybody. There's no question about that. The death toll rose pretty fast, and then it came back down rapidly as well. The more new cases that came on board, the better off we were at trying to battle this thing. But when we got into the fall and winter months, everything surged up again. You could see that the new cases went up. You could see that unfortunately, the death toll went up as well, the daily deaths per thousand, but it also came down rapidly again. And we're in pretty decent shape right now as the U.S. Moving forward. Now, you compare it against the global COVID-19 cases and deaths, you can see they're not faring quite as well, but you have to understand also, like the U.S., you had certain states that started out worse than others, and then they got better, and then other states got worse, and then they got better. So it's kind of like, I hate to say it this way, but it's kind of like being diversified in the market in that because there were ebbs and flows between the states, it never got really out of control across the United States all at one time. And I think we're seeing that now with the global cases. You've got some countries that are doing much better now, but in the beginning were doing poorly. You've got other countries that were doing okay in the beginning, but now they're doing poorly. So, but it's on a global scale. And you can see from a global standpoint, we're actually getting a little bit worse right now. And, but for the US, we're certainly getting it more under control. So if you had to put a report card out there for the overall COVID crisis, well, positive developments, well, the COVID cases are falling. Hospitalizations and fatalities are lower. Vaccinations are accelerating. The second wave of economic pain really is not going to be as bad, hasn't been as bad as the first. And the economy's now recovering. You look at the really the enormous U.S. fiscal stimulus that was put out there. That's one of the things that's keeping this economy moving forward. And then we have above consensus growth on all forecasts moving forward. What does that mean? It means everybody pretty much thinks we're going to be moving forward and we're going to have a pretty good 2021 moving forward. Looking at the negative developments, you got a new variant, which is a little bit harder to control. There could be a third wave forming in the U.S., but that is questionable. There certainly is across the globe, though. You look at Canada, you know, our neighbors to the north, the vaccination rate is kind of lagging a lot of the wealthy nations. And I'm sure most of you have heard in the news that they're starting a whole nother wave of shutting down their economy. The vaccines, well, some think that they're a little bit less effective against some of the new variants, but there is herd immunity coming. Some people are wondering if it's going to be a little bit elusive, but I've got another chart which I think kind of shows you that it's not that far down the road that we will have that herd immunity. And there are some rising inflation fears. Couple interesting notes. Number one, we do expect that there is going to be a limited consequence to the pandemic and moving forward. The housing market right now, if you're thinking of selling your house in the next 6 months, now is the time to do it to reap the biggest reward out of it. Now, if you're thinking about buying right now, you might want to wait a little bit because I think we're getting towards the height of the market from a housing standpoint. And then, you know, there are rising bond yields too. So that for some people is going to be very good. Many of you have seen these indicators. They're put out by City National Rockdale's research department. And as you can see, when they're really drilling down to the three major areas relative to the COVID challenge that we have out there, the COVID-19 spread mortality has improved tremendously from where it was. The COVID-19 testing is continued to get better. It's neutral, but it's moving towards the positive side. And then the policy response from a fiscal standpoint has really kept things moving. So that brings us to this chart, the path to the end of the health crisis. And this is where I was talking about. Maybe we're getting close to that time where we can all get back together again. What this chart shows is you've got basically 4 different areas here, 4 different colors. The black really is the daily new infection rate, which is really dropped down dramatically. Then you have the blue, you know, the solid royal blue. That's the immune from the people who have been infected. So people like myself who have had COVID, we now have the antibodies, and many say that that's actually better than a vaccine. But the fact is we need the people who are vaccinated. So the immune from the vaccinations is what is going to put us over that 60% level that most specialists feel we need in order to get that herd immunity. And it looks to me like we should be hitting that somewhere around June, July. So I don't know, Rocky, things are looking pretty good there. So I'm thinking that sometime this year, maybe not in the too distant future, we will probably see that we're going to be all getting back together again. So I'm kind of happy about that. You know me, in our office, we're social people. We like to be out there with our clients. We like to shake hands. We like to hug. We like to talk. And Rocky, I think we're getting close to that. So some very positive things coming down the road here. And I am happy because of that.
Yeah. I'm ready for a workshop just for the food. So anyways, well, we know we're on a limited time schedule here because we got started late here. Let me continue moving forward and start talking about our recap of the market for 2020. So we went through COVID. That was a big impact, but let's go back and look at the economic indicators. When we were in January of last year, boy, we thought things looked pretty good. If you remember, green is things are in good shape, yellow dials is cautionary, and red is not good. So at the beginning of last year, we were riding pretty well. The only things that were red was political unrest and geopolitical risk that was going on, which was pretty standard. That's been that way for years. But the rest of the economy, when you're looking at the labor markets, the consumer spending, interest rates, things like that, things look pretty darn good at the beginning of the year. However, literally 2 months later, the whole picture changed with COVID coming on the scene and the decision to shut down the economy. So we were not looking good at this point. Many things turned negative with the economy shutting down. The labor market went dead. The housing market stopped. Basically, people weren't even able to show homes during this period if they wanted to sell. Consumer sentiment, terrible, right? People just didn't know where we were going. However, where did we end the year up? An amazing turnaround. In fact, this was the shortest recession and recovery in the history of the United States. Okay, and a lot of that was due to the fiscal response of the government to pump money into the economy, to drop interest rates. We're going to go into that in a little bit more detail. But where we ended up the year, things were looking pretty good coming into 2021. When we recap the broad markets, this is the US market, the international markets. What you can see is the first quarter, Q1, everything was down because of the pandemic. But look how fast things turned around. By Q2, we saw US equities leading the path. International had bounced back, emerging market had bounced back, and the bond market had regained some strength in the second quarter. And that continued through the third and fourth quarter to where, if you look all the way to the right, your year to date, where we ended up, US equities very strong, international equities not bad, 8.3, but the emerging market actually outperformed the US market in last year. And then the bond market stabilized and had quite a good return, the blue bars here at the right side of the screen. So overall, 2020, with everything that took place, unprecedented situation of actually closing economies around the world, turned around pretty significantly due to the government response around the world.
But I find that incredible because at the end of the day, it was such a horrible year, but it could have been so much worse if the market wasn't supported the way it was.
Right. So as we go and look into a little bit deeper dive into sectors within the economy, what you can see if you focus on the left side of the screen, the S&P halfway down, the black bars, kind of represents the general overall largest 500 companies in the U.S. fared very well, ending at 18.4% up for the year. But now you can see how different parts of the economy, energy, financials, industrials, materials, and so on, how did they individually fare? And you can see energy took the biggest hit. And real estate was actually down, and that's part of the reason I think there was pent-up demand and why we're seeing such a resurgence in home prices and things like that in 2021. Now, if you look at the right side of the screen, basically this breaks down the economy based off a company size, from small companies to mid-cap companies and large companies. You can see the large companies were the biggest winners at the top and at the very bottom. Large growth was the biggest winner of the year. That was led by a few small companies that we're going to talk about in just a minute. But overall, we worked ourselves out of a recession back into positive growth in the economy. Again, from the credit markets, you can see, and I'm only focusing on the right side of the screen here, the year ending numbers. You can see that the leader was actually long-term treasuries, because the Fed went in and bought a lot of the bond market to prop it up and to keep it from going down, kept it from defaults. So when you looked at investment grade bonds, even high yield bonds, which are traditionally risky, the fact that the government came in and bought a lot of the bond market to support the low end of it, to keep it from going down, that bolstered it and gave us positive returns in the bond market last year. We talked about what kind of recovery. If you remember back in March, April, May, June, we're saying, what kind of recovery are we going to have? Is it going to be a quick recovery, which is a V recovery? Is it going to be a U recovery, something that takes a long, drawn-out process to recover, like 2008 was? Well, it actually turned out to be what they call a K-shaped recovery. And basically, all that was saying is there was winners and there was losers last year. So the economy recovered as an overall, but many companies did not. In fact, many companies actually went out of business last year. So when you further dissect the type of recovery we had, you got to look at, well, what took place and caused the kind of recovery that we had, the short-term recovery we had. And it's because of the amount of stimulus that was pumped into the economy by the Fed. And the chart on the left, the pink area shows that literally interest rates, borrowing rates for corporations and banks went from 2.25% all the way down to zero inside of a 12-month period. That's unprecedented. And when you compare that to the blue lines, the light and blue lines, these were previous recessions and recoveries and how fast the Fed responded by reducing interest rates. And why is that so significant? Because companies needed to borrow. And if it was too expensive to borrow, they wouldn't do it. So the fact that they could actually borrow money at zero meant they could reinvest that money at no cost to them from an interest rate standpoint and get their business going and keep their business going. So it was unprecedented recovery due to an unprecedented Fed rate cut over time to get interest rates to a place that companies can borrow and stabilize their business. So this was huge last year, and you can see the comparison between previous recoveries and this one. Again, what caused the economy to come back so fast? Now, when we look at last year, what's interesting to note, especially now looking back at it, the biggest recovery really was supported by the 6 largest tech companies in the United States. And that's what this blue bars are representing. When you look at last year, the majority of the return came from Facebook, Apple, Netflix, Amazon, Microsoft, and Alphabet, which is Google. Those companies led us out of the recession. When you look at the orange, that was the other 494 companies in the S&P. Didn't fare as well. In fact, some actually lost, which you don't see in that net number. But overall, 6 companies were the main contributors to last year's index performance. And when you look at the right side of the screen, this represents the international market. And what you see there is the top 20 companies in Europe basically led the way for Europe to come out of the recession too, with the remaining 128 companies only doing about 14%, while the top 20 returned about 47% for the year. So technology drove the market last year and helped the recovery.
Yeah, that was part of the K that went up, right?
Yep, that was the K, the upside of the K. The other thing is when we looked at what took place from a consumer and business standpoint on how individuals and businesses felt about the market, the black line represents the University of Michigan consumer sentiment. You can see how it dropped off completely from really historically high optimism going into the 2020 all the way down, dropped more than half down in consumer sentiment, but also small businesses totally dropped off. But because of the stimulus, because of ability for companies to borrow, the stimulus checks that started coming out, all that bolstered the economy and improved people's feeling about how fast of a recovery we could have. And you know the consumer drives much of what goes on in the United States. Consumer spending is at the core of our economy. So with that, I'm going to have Dan hop on and talk a little bit about the national debt, because that was a definite contributor to what response took place last year. So
yeah, it's really interesting because every time we do the market past and present, we take a look at where we are on the national debt. And if you've been with us long enough, you're seeing the numbers do this every single year, a little bit higher, a little bit higher, a little bit higher. Well, last year wasn't any different. So we'll take a look at what went on last year from a national debt standpoint and what's driving it. And then also, kind of where were we last year or the previous year, 2019, in the debt standpoint. So you can kind of see the rise between the two. So national debt. Let's take a look at this. And I think we put this out, Rocky, mid last year. We were talking about the national debt and the debt over time. And what we were looking at with this chart was the debt held by the public as a percent of the gross domestic product, so the GDP. And then what we did was we also overlaid the last 6 presidents over the mountain chart there, which is the debt. So what does this tell us? Well, it tells you that in Reagan and Bush time, they had a pretty big increase. Clinton had the biggest decrease. G.W. Bush, a little bit higher at the end. Obama, ouch. That was probably the biggest increase. You look at Trump. Trump was actually doing very, very good all the way up and through 2019. It wasn't until 2020 and the crisis hit that you saw a spike in the overall national debt. And then you can see now in 2021, it's now 102% of the GDP, when during Trump's time all the way up to 19, he was at 79. So that's a troubling thing when it comes to debt. But what's more troubling is where they're projecting the debt to GDP, where it's going in the future. And it does not look pretty if we don't make some major changes moving forward. So where are we today? National debt, well, this is as of a few days ago. We're at $28 trillion. That's $85,000 per person. That means the baby that just got born today, well, they're starting out in the hole at $85,000. That's how bad it's gotten. If you look in the lower left-hand corner there, that was the 2020 or 2019 total at the end, and that was at 27,850,000,000. So we are continually moving forward from a national debt standpoint. And guess what? The piper's going to be paid here sooner or later. Here's something to think about. Why is the national debt so high? Well, think about the government spending and really think about your household. If you're bringing in income and you're spending less than you're bringing in, that means you're going to have a savings, right? You save for a rainy day. Well, the government really, from time to time, does have to spend more than they're taking in, but eventually they got to get back to that situation where they're bringing more in than they're spending. Otherwise, the debt continues to get out of control. And what you can see in this chart, you've seen the ebbs and flows. In 2000, it was below $1 relative to the spending. Matter of fact, it was around 85 cents to every dollar that we were bringing in, we were spending. And it went as high as $1.75 in 2009, then started coming back down again. But you can see what happened in 2020. We literally spent $1.92 for every dollar of revenues that were brought into the country. And that is in the form of taxes, the revenues that's coming into the country. So it's a little bit taxing. We can't keep up with this for too long. We're going to have to get it under control. And what does that mean? It means that you have to do one of two things or both, probably both. You've got to get the economy moving very robustly. And once you have the economy robustly moving, you got to start raising taxes to some degree. And that is what's being anticipated here. Again, this is just another way to look at the other chart, revenues first versus spending in 2020. The total revenues coming in, again, taxes, was 3.4 trillion. Total spending, 6.55. A little bit out of control, but that was to help keep the economy moving. You go back to 2019, again, the lower left-hand chart there, you've got 3.4 trillion, 3.46, very similar to last year, was brought in revenues, but the spending was significantly less, albeit still over what we were bringing in. That's one of the things that's creating the potential problem. And one of the things I would say, Rocky, is when you think about the debt. I had a client ask me yesterday. They said, you know what, you keep saying that taxes are going to go up, but we're not seeing it happen right now. And one of the things I brought up with that client is, yes, it is already happening. And let me explain this. About a year and a half ago, the IRS changed the rules relative to inherited IRAs. So what was the rule change? Well, we used to be able to do multi-generational IRAs. So if you had a large IRA, you could actually pass it on to the kids. They could keep it as an IRA, and then they could work a strategy to eventually get that down in a reasonable manner. Well, what has changed? Well, what they've done is they've literally said, no, can't do that anymore. You have to have the assets liquidated in 5 years. So they've got 5 years now. They have to liquidate that IRA. So think about it from a tax standpoint. Initially, we could have deferred, created a strategy, and reduced in a very systematic way that didn't cost a lot of money from a tax standpoint. Now what happens? Well, if I have $1 million inheritance of an IRA, and let's say I'm making $150,000 a year as the beneficiary, well, I have to get that $1 million out of that IRA within 5 years. So what does that do? It adds $200,000 of income to my $150,000 income every year for 5 years. Now, where did my tax bracket go? I just went from sitting at a 22% tax bracket and jumping up into the 32% tax bracket. So it is a raise in taxes any way you look at it. All they did was accelerate how you have to pay it. And because they accelerated it, they raised the taxes. So when you say it's not coming or it hasn't come yet, Well, it's here today. They're already starting this process. They're doing it kind of stealthily, which is very similar to what they've done in the past, but it is starting to occur. If you're a legacy client, you might want to have a plan for this. Otherwise, your kids could get whacked really bad when it comes to taxes when you pass away. So strategy is the key. It's what Rocky said in the beginning. It's not just the investments, it's how do you strategize? What kind of strategies of advanced planning do you put into place that allows you to mitigate this problem that's coming down the road and is already starting to occur at this point? Okay, where we are today. All right, let's keep going then. Where we are today, again, going back to the economic and financial indicators, looking at January 2021, again, we're looking pretty nice right now, or at least in January. This is 1 year later after things have kind of fallen off the rails and then got back on, but it looks good looking in January. You take a step forward to April and oh my goodness, Rocky, when was the last time you saw that chart where it was all green except for 3 yellows?
Yeah, that's interesting.
Well, it is.
That's a long time.
Yeah, I don't know the last time I've seen that. You know, you could probably contribute the geopolitical risk going yellow to all the peace deals that went on the last couple of years in both Europe and in the Middle East, because you get the Middle East stabilized, the geopolitical risk goes down. So there is that. The political environment, I don't know what's going on there, but it's yellow right now, and we're looking pretty good moving forward. So let's take a look at some of the conditions that we think are really going to be favorable for this market and the economy moving forward. First is, well, you look at the low interest rates, you look at the high liquidity level, you look at the accommodative monetary policy that the Feds have given us. You look at the fact that the businesses are able to access finance cheaply and relatively easily. Well, what does that say? It says that at the end of the day, there is room to run. If you look at the St. Louis Fed Financial Stress Index, it was pretty high in April of 2020. You look at it now, it's pretty low. So we've got a lot of room to run up in this market in the near term for sure going forward. Money on the sidelines, this is another one. Money on the sidelines doesn't stay on the sidelines for very long. People want to incorporate it into something that's going to move them forward. So you've got 2 lines here on this chart, and it's the household net worth and the corporate cash. The corporate cash, we'll look at that one first. That's the blue line. It's only been higher than where it is right now, looking at this chart, about a month ago. It is really doing very, very well. The corporate cash structure, they've got money, they just need to deploy it, and they will. You look at the household net worth. Well, you go back to 2016, the household net worth has been increasing year over year over year. You've had a couple dips in there. You had one at the end of 2018-19. You had one from the COVID crisis, but it has never been higher. So, this isn't just the wealthy high net worth or people. It is everybody. The old saying, a rising tide rises all ships, is no truer than here. So you've got people in poverty that was lifted out of poverty. You got people that were lifted out that came up a little bit higher. Your middle class has gotten better off for the first time in many, many years. And then obviously you're going to have wealthy people get wealthier as well. But at the end of the day, everybody got lifted up. So that's an awesome thing. The other part is pent-up demand. If you think about it, most of us have been locked up so much, we want to get out. I mean, when was the last time you went to a movie? Rocky, when was the last time you went to a movie? I died.
It's no black and white. I can't.
Well, mine were the talkies. Yeah, it's been a long time. So think about it. The 2020 average spending versus the pre-pandemic, transportation and warehousing, well, that's down 44%. Arts, entertainment, and recreation, that's down 47%. You look at the accommodation and food service, that's down 33%. What do you think is going to happen with all this pent-up demand? It is going to rise. So this is going to be another part that's going to boost our economy. With all that good news, we can't be chasing after things in the market. And this is so important. So when you think about chasing last year's winners, it can be a very, very hard losing game. And all you have to do is look at this chart where it shows emerging markets, international, US high yield, all the way up to US equities. And it has a key on the right-hand side. So let's just take a look at US equities, which is the dark green. Now, if you think about it, in 2015, if you would have said, well, you know what, 2014 and 2015 were really good, I'm going to jump everything into US equities. Well, the US equities dropped down to third place at that point. Okay. Well, what if you were in 2011 and you were in US bonds? Well, I was at the top of the ladder. They did so well that year. Let's do it again this year and put everything in US bonds. Well, in 2012, where did they go? They were second from the bottom. So what this chart tells you is you cannot predict from last year's winners who this year's winners are going to be. That's why diversification is so important within the portfolio. So never run after last year's winners, because it can very well be a losing proposition. So diversification is the key. When you look at this chart gives you really the global equities and the global bonds. And think about it this way. If you were never in global equities and never in global bonds, would your portfolio have been helped or hindered? Well, when we're looking at this chart, it really depends on your risk tolerance. If you were a full equities person and you ran into this crisis, your account would have been down significantly, but it would have bounced back relatively quickly. And if you were looking at it at the end of the year, you would have been ahead, but you would have had a lot of volatility. If you were a mixture of global equities and, let's say, global bonds leaning to the bond side, it wouldn't have gone down as much, but you still would have had a decent end of year within that portfolio. So you can navigate volatility just by adding diversification within your portfolio. And nowhere is that more evident than the global market. All right, where are we right now from a valuation of the S&P? So the S&P forward price earnings ratio. You can see, if you go all the way back to 1999, how overvalued things were back then. That's when the tech bubble broke and everything just kind of fell apart at that point. Well, you can see now that we're still within the fairly priced range, and actually better off today than we were a few months ago. So we are not overvalued. We still have room to run down this track to the end of the year, to where we believe, again, the S&P should be up somewhere between 8 and 10% by year end. Now that's obviously, you got to take a look at if there are any black swans that occur. What's a black swan? Well, just look back to March of last year. That is a black swan, something that nobody anticipated. But short of that, we think we're going to have a pretty decent end of year. Could be volatile, but we're going to have a pretty decent end of year. That being said, I'm actually going to pass it over to Rocky, and Rocky's going to run us down to where we are today and moving forward, and what we seem to think, or what the stats are telling us we should have.
A little bit of forecasting. So here's where we think we're going to be going. Okay. What I want to show here, and you're not expected to be able to read these. I know these are a little smaller, but what we did is we put 3 different charts on the same page. And what we're seeing for 2021 is probably one of the strongest recoveries we've seen in the last 40 years. The top chart is retail sales, the bottom left, building permits, and bottom right is manufacturing. When you look at each one of these areas, we're seeing strength that's coming from consumer spending, from the housing market, and manufacturing, and we believe that trend is going to continue. It's going to continue to be very strong throughout the second half of this year and into next year. When we look at job recoveries, the slide on the left shows that 63% of the job losses have been recovered going into the first quarter of this year. Now there's still an $8 million job shortfall, people that haven't gotten back to work yet. But if you look at the chart on the right, because the economy is opening up, more companies are being able to get people back to work or bring new workers back into the workforce. The number of new job openings is trending higher, and that's what you see in the bars on the right side. Those gray bars are continuing to go up. That is not employment, that is job openings. You have to have jobs for people to go back to work. So if the job openings are increasing, the opportunities for people to get back to work are increasing, and that's what we're trying to show here.
Well, you know what's interesting, Rocky, on that slide is and this is something I would tell everybody out there. If you know someone who is on unemployment and they have the ability to get back to work, I would encourage them, get off unemployment, even if they're making more, and get back to work. Because my concern, and a lot of business owners' concerns right now, is that the people who come back are going to be the cream of the crop. The people who really didn't come back or not trying to get back to work, they could be left on unemployment because the business owners, there is a trend to cutting back a bit and getting more lean and mean again, just like they did in the tech bubble crisis that we had.
Yep.
So I would encourage people, even if it's a short-term loss, to get back to work, because the jobs are not going to be there the way they were prior to this pandemic.
Yeah. The thing I think of too is unemployment doesn't pay health benefits. You got to get back to work to protect your family.
That's right.
So anyways, on to the overall market. What we're seeing in our forecast for the year is, when you look at the left side, this side is representing equities. Where do we see the growth opportunities in equities? In U.S. growth, in dividend and income stocks. Small cap is the largest. The bar is not showing up well there because the color didn't come through. The only place we're seeing a downside is the developed European markets. And again, part of their problem is COVID has really not been decreased like we've done it in the United States. Emerging markets, we're expecting a great amount of return in this year because they went so far down. And the fact that the U.S. economy is strong and consumer spending is strong, that bodes to help with the emerging Asian market too. When you look in the center of the chart, the core fixed income, taxable and tax exempt bonds, not going to produce a whole lot. Okay, why? Interest rates are rising, so the value of the current bonds out there aren't going to bode as well. Where's the opportunity? We see that more in what we call the high yield market, which is the green section, opportunistic fixed income. So that, because the Fed came in and actually supported by buying bonds last year, we see that there's going to be opportunity in higher risk bonds. Again, remember what I'm saying is higher risk. So the volatility may come with it too, but the opportunity on the fixed income side is going to be in those higher risk type bonds. And then alternative investments. Alternatives can be private placement, equity, real estate, and things along those lines. Maybe even some commodities, gold, silver, things like that traditionally do well in rising interest rate environments. And then what do we assume for a balance or project for a balanced portfolio, 60% equity, 40% bond. That's that black bar. So we're looking at a 6 to 8% potential return by the end of 2021 in that type of portfolio.
Now that would be a gross amount, right?
Yes, that's a gross amount.
Not a net of fee and expenses that you have.
Right, these are just pure numbers based off of market indexes. So next section, we're talking here on this slide about where the focus is. Now remember I told you earlier, the Facebook, Alphabet, Netflix, Amazon, Microsoft, Apple, those companies drove the market gains last year. Well, that shift has already started taking place where we actually saw the NASDAQ in the first quarter of this year take about a 15% hit. It actually went down while the Dow and the S&P continue to be stable or slightly moving forward. So there's a sector shift in the market away from the high growth, high tech back into more your stable companies. And who is it representative of things like that? That would be like your Johnson & Johnson, right? Your Coca-Colas, your big companies that are big international companies, but they're more consumer product oriented. They're not tech oriented. So this is basically talking about we don't want to be over speculative going into this year and next year. We want to go back to more traditional dividend type growth companies and things like that. So that's where we're making our focus. Again, high dividend stocks relatively to growth stocks have not performed as well the last couple of years. And thus we shifted away from that into growth. But that trend we believe is going to reverse. What do we want to buy? We want to buy stocks that are low priced, that are valued priced right now. They're not overly expensive. So we're making this shift in the portfolios away from growth. Not that we won't have any growth, but shifting it more to a balance of bringing in the less expensive high dividend stocks back into the portfolio, because that's where we see the opportunities moving forward. When we look again at the fixed income side of it, the blue lines represent the high yield market, where the yellow represents the investment quality grade bonds. Again, like we talked a couple slides ago, the opportunity is going to be more in the riskier section of the bonds moving forward, as you can see in these charts. So that's what we're projecting. We're bringing more of a balance of high yield into the portfolio, less treasury, less corporate grade. So that's where we're going to get the return from over the next year to 2 years. Another problem that kind of still exists out there moving forward, and why inflation is being talked a lot about, but why it's not a big concern, is because we're not seeing inflation in all areas of the economy. We're seeing a big imbalance depending on industries, depending on the types of products and services that they offer. So when you look at the chart on the left, basically what you see is that the Fed has a target, and it's the gray flat line. The Fed wants to target about a 2% growth or inflation rate. And that's measured by the core price index here, which is the black line, which has been very jittery, very up and down since 2000. But their target is about 2%. Historically, since 2000, we've been running about 1.7, 1.75, which is the dotted blue line. And you can see we are well under the targets. So even if inflation is coming back and moving up, we don't see that as a problem over the next year or so. And that will bode well for growth in the stock market. When we look on the right side, we see that paper products, used cars, and cleaning products, obviously, right, with COVID, cable and satellite TV, eating at home, those have kind of gone up quite a bit year over year and have been inflationary. Yet when you look at other parts of the economy, airlines, hotels, public transportation, clothing, those things are down and significantly down. So we're not having inflation across the board in the United States. This chart is really kind of cool. You don't have to get into the details. I'll tell you overall what's going on here. These are 13 different inflationary periods in our economy. What I want you to focus in on is the right side and whether the S&P during those periods actually gained money or lost money. And you can see only 3 periods out of the 13 with rising interest rates did the S&P actually go down. Because we're at historically low rates, and just the fact that interest rates are going up doesn't necessarily mean that's bad for stocks. That can still be a bullish sign because it actually is saying the economy is stronger. As the economy gets stronger, the Fed's going to raise interest rates to keep it from getting out of hand. So you can see historically here, we believe that we're still in a very good position, even if interest rates trend up a little bit moving forward. However, in a rising interest rate environment, we also expect to have increased volatility. But when you look at the volatility over this chart here, starting in 1980, the black or blue lines, depending on how your screen is showing it, represented how the S&P ended up for the year. So most of the years, you see the black lines are above zero. So we had many, many more years of positive returns than negative returns. However, the red dots or squares represent somewhere in that year how far the market was actually down. And you can see pretty much year by year, sometime throughout the year, the market was actually down. So if we go into a period where in June or July, you see this market correct and goes down, don't worry. We see the long-term trends. We will readjust the portfolio. If that happens, we will rebalance for it to come back. But we expect the trends long-term to be up this year going into next year. One of the reasons we believe that, and that's going to stay on that trend, is because Fed policy, they're projecting keeping interest rates significantly below average over the next 3 years. I mean, they have a personal interest in this too, because this also applies to the interest rate we're paying on the debt. So if we don't have to pay a whole lot of interest, it's easier to pay down our debt over time. Okay, so that's one of the strategies they're wanting to employ. Raise taxes, but keep interest rates down so that we can get the debt back under control over time moving forward. But this picture, the Fed taking a low interest rate approach to the future, bodes well for companies as they borrow and try to expand. So we see that being a long-term positive trend for the stock market. Again, here we are expecting multi-year expansion, even if taxes go up, because we believe that there's enough with low interest rates that corporations can borrow and continue to invest in the growth of the economy moving forward. And the consumer is right there, as you can see in like the housing market and things like that, that the consumer is willing to spend. So that is all boding well. The GDP projection for this year, on the right side, you see for 2021, between 5 and 6.5%. I personally believe it's going to be closer to that 6.5%. Okay. Next year, it's going to normalize a little bit, somewhere between 2.5 to 4.5%. But if you look down at the chart below, basically GDP growth of 2% to 2.5% is pretty normal. And we've had great stock market returns of 6 and 7% in those years where growth has only been 2.5%, 3%. That is still solid growth for the United States, but it could be as high as 4.5% in 2022. Corporate profits, this year we're expecting 25 to 30% because again, the economy is getting back on board and getting back to more normal. So during that process, obviously, they're going to do better than normal to get back on track. Next year, 2022, we're expecting 10 to 20% potential profit growth for corporations. Again, bullish, very bullish for many years moving forward into 2022. Fed's fund rate, they said they're going to keep it low. Interest rates, as a result, will remain low. So all these play into the factor that we believe going into 2022, things look very, very solid for maintaining our portfolios. That is where we see things going. I'm going to bring Dan back on here with me, and we're going to kind of wrap things up. So we hope you've learned a little bit moving forward.
Well, Rocky, remember, and I don't know if we had it last year, we certainly had it the years before, but we have a chart that really shows the treasury rates relative to the growth in the market. And it's a chart that has a bunch of dots on it that show the treasury rate, and it also shows what does the market do when the treasuries get too high or when they go down low. And that chart effectively says that 5% is the tipping point where if the treasuries get up around 5%, the stock market trends to the downside. And the higher it goes, the more the market goes down. But as you can see in the chart that Rocky just showed you, we're nowhere near that number. And so that is a very bullish sign for moving forward, certainly this year, and quite frankly, probably next year as well.
It could be for many years if the Fed can keep interest rates down to where it makes sense to borrow. Again, it's no different than when you go to your bank. What are they paying you to put money in the bank? Nothing. So you're looking for somewhere else to invest in. If they were giving you 5 or 6% on a bank account, you'd probably put some money in there right now. But you're not getting rewarded unless you're taking risk. But we're keeping our eye on it and watching the trends and making sure it makes sense to take risk and get the return you're looking for. So we will keep our eye on that.
Okay, so I guess when you're looking at the near term and long term, short-term drivers, when you're talking about it from an emotional standpoint, it's always fear, it's panic, it's greed, it's overreacting, and it's trying to time the market. And what do we say when it comes to investing? You got to take the fear out of it. You don't want to panic. And if you have a plan, you shouldn't have fear, you shouldn't have panic. Now, our job from a coaching standpoint is to make sure that greed doesn't enter in on this, and there's not overreacting, or people aren't trying to time the market because they've got certain positions that have really, really excelled, kind of like a Facebook or a Apple. So that's where we come in from a coaching standpoint. When you're looking out longer than, let's say, 18 months, the long-term drivers, now you're looking at what direction is the economy going? What kind of revenues are out there? What kind of profits? What's the cash flow? Is there a competitive landscape? Is there innovation? Because that's what's going to drive things long term. And we feel, as Rocky had said, that we're looking pretty good with that moving forward. What are the action items here? For you want to keep us in the loop when it comes to important life events. You want to share any concerns you have about your investments, so we can talk about that, and we can give you the education and the understanding so you feel comfortable staying the course. And then update your important legal and financial documents. The landscape changes out there. I say this all the time. We're a tactical wealth management firm. It's not just investing. We look at the tax landscape, the financial landscape. We look at the legal landscape, the risk landscape, and all of this. Think of it like a 3-level chess game. You're always looking to implement your strategy and stay on course so you can win the game. And that's what we do at our firm. And you also have to know your gaps. So if a gap comes in other words, you have something that could actually hurt your estate, we need to know that right away so we can fill that gap and make sure that we don't have a problem down the road. And then there's also no time like the present to roll out your charitable intent. There's a lot of need out there. If you are charitably inclined, we've got great strategies that will help you help other people. So I think that's an awesome thing. And we got a lot of clients that do that. Now, our action plan is to keep you informed through the regular communication like we have right now. And hopefully in a few months, we'll have you all back in the office for some face-to-face type presentations here. We will manage your investments according to your personal strategy, not your neighbors, not your brothers, but your strategy. And we will get all we can get out of that strategy for you. And then we've got to stay on top of the changes that are going on in the markets, as well as the tax, legal, and risks out there. And as we see changes, we will bring them to you. And then ultimately make prudent adjustments when necessary as they relate to your long-term goals. Our clients always finish the race on top. Probably am not allowed to say that from a compliance standpoint? I don't know what
top is.
Well, okay, Rocky doesn't know what the top is.
Not the middle or lower.
So they keep improving. I'm always optimistic. I think if you stay optimistic, life is a lot more fun. Someone asked me about my COVID experience. I ultimately said it was a big blessing in disguise. I came out refreshed, my productivity was skyrocketed, and I feel great. So probably not too many people would say that, but hey, that's the way it happened with me, and I'm feeling good. So I think the future is really coming to us in a very, very vibrant way right now. So we'll see what happens there. So where are we? Again, if you want more information, you can just go to Daniel Krug and Associates YouTube channel. And in doing that, you'll bring up all the different videos we have. The video we have on today, the one we're doing right now, it will be put out there Friday, like it always is. And you will get an email that basically says, hey, just click on this link and you can go to the YouTube site. If you want to go there sooner, just type in Daniel Krug and Associates YouTube channel and go to the videos, and it'll literally bring up all the different videos that we've had. And we do break the videos down into segments. So if you've only got like 10 minutes to watch a specific strategy or a specific part of a video, it's an easy way to do that for you as well. We will be expanding from YouTube onto different sites as well in the future here. So not too distant future, you'll be able to go on to other sites if you're not a fan of YouTube and see what's going on there. So that's where you can get a lot more information. And again, hopefully in the next few months, we'll be able to ultimately get people in here. So, it's what we say. There's no need to worry. You take care of your family, and we will certainly take care of you. We're ready for the future, and we are excited about it. So there's a lot of cool things going on. We can't wait to see you all back in the office and to be able to kind of show off our new office. So we're very, very, very proud of it. And I think you will be too when you come in. So,
all right. Well, we appreciate it. Thanks again for joining and hanging with us through the problem at the beginning. We'll keep working to make it better and better, but the recaps will be good to go out and see on YouTube. We will edit out all the things that you didn't want to see, only the good stuff. So anyways, you guys have a great day, and thanks again for joining us.
All right. Bye-bye.
Bye, everybody.